Thank you, gentlemen, for joining us today. I guess I would just want to start off first by kind of giving some background on your funds, sort of what your investment theses are, where your focus is, and then kind of get a general understanding of, what's the current status of the deal environment out there, and what do you think the short-term versus long-term outlook is like. And then in addition, look at, what is your outlook right now for fundraising, and how is that impacting your decision-making today? Let's start off right now with Michael.
Yeah, excellent. I think there was 4 questions wrapped into one. So good morning. My name is Mike Teplitsky. I'm with Wynnchurch Capital. Wynnchurch is a private investment firm, a private equity fund, headquartered in Chicago. We have approximately 24, 25 professionals today. We've been around since 1999. And as of today, we're managing just a little bit over $1 billion. We're actively investing out of our third fund, which is a relatively new fund that we raised in March of 2011, which is a $600 million fund. And out of that 600, we have approximately $300 million left. And really, our strategy is pretty straightforward. If you look at our portfolio today, which is 20 companies, 80% of those companies are engaged in manufacturing. And a lot of this is basic industry, old economy kind of businesses tied into industries such as automotive, building products, oil and gas services and equipment, industries like that. Aerospace and defense is another space we've been spending a lot of time in. And really, our strategy we perceive to be highly differentiated. We really focus on performance improvement and adding value to these businesses. And we tend, for better or worse, we tend to get involved in more storied or complex situations. And what do I mean there? Well, a third of the companies we've bought over time have been family-owned businesses that had some sort of dynamics going on there that could benefit from a partnership with us or a sale to a firm like ours. A third of what we do has involved acquisitions from both private and public companies, but so asset divestitures, disposals, and some of those have been pretty straightforward, where you've got a standalone business with its own management team and companies doing well. Some of those have been pretty tough ones, where business might be pretty integrated, may not have a C-suite type of a team, maybe having elements of underperformance. So for example, we bought a company last year that's in the housing space that over the prior 4 years had lost $100 million. And it had negative EBITDA for almost each and every quarter for 4 years. So that would be a pretty tough deal. And then the last third of what we do involves businesses that are underperforming. So a lot of distress type of investing. We've bought businesses through bankruptcy processes, restructurings, both in court and out of court. And really, at the end of the day, what's our angle? Number one, it's getting these tough deals done, where other potential buyers might say, hey, we understand what's going on here, but you know what, this is a little bit too much heavy lifting. And we've got some guys at Wynnchurch that have a background in performance improvement at large turnaround consultancies like Alex Partners and Alvarez and Conway. We have people that worked in the industry. We have some of my colleagues have worked at commercial banks. Our founder came out of GE Capital, so we have some colleagues that used to work in the workout or special asset management groups working out tough loans. So we add value through the tough acquisition, then through the first 100 days helping the companies really develop its strategy. But we're really involved at the board level. And a lot of times people ask, well, do you bring in a management team 100% of the time or not? It's been probably 50% of the time. So, and we'll talk more about that. But that's Wynnchurch in a nutshell. And we're focusing on 50 to 500 million revenue companies that may be profitable or maybe doing 10, 20, 30, 40, 50 in EBITDA. That's kind of our range. We're writing equity checks of 10 million to 100 million.
You guys talked a lot about adding value to the companies that you're purchasing. And I guess I want to dig in a little bit more about that and try and understand more about how is it exactly that you do that. You're looking at buying these companies that have typically been around for 30, 40, 50 years. They've done a good job growing the business. What is it that you are bringing to the table that's ultimately going to take them to the next level? I guess, Michael, start off with you.
Sure. Well, every company is different, and every company is in a different, that we get involved in is going to be at a different point of its life cycle. So one company might be growing, family-owned business that's at an early stage of a good cycle. We may get involved with a business that's owned by a strategic, so part of a larger corporation that may be underperforming and not in a great point in its cycle. But at the end of the day, what we spend a lot of our time thinking about is, okay, what do we need to do to accomplish our objectives? What do we need to believe in to make this investment? And fundamentally, how do we add value to the businesses is really, most importantly, number one, it's incentivizing whoever's going to run the business to try to set good objectives that are reachable, that are realistic, and that provide to us and our investors the kind of return that we need to see. And so if you look at the investments we completed last year, and there were 6 new companies we added to the portfolio. We acquired 3 additional businesses, so much smaller add-on acquisitions. And as I just looked through the list of what we've done so far with the new investments, with one company that's in the oil and gas equipment space, we put on the board former president of a very large public company. And the business that we bought, its strategy is really focused on, its largest customers are in Asia. So the executive that we put on, we made the chairman, has a lot of contacts in that part of the world and has been working with the current management team to go out there, make sales calls, and win new business. We're also working with that company in trying to professionalize its strategy deployment process and really thinking about what the objectives are. We also then got involved with a couple of really tough situations. So, for example, we bought a company called US Pipe, which makes ductile iron pipe for water infrastructure. We bought a business called North Star Aerospace, which makes gears for Apache and Chinook helicopters. Both of those businesses were having a lot of issues when we purchased them. In the case of US Pipe, we kept the management team. They went out and have done a lot of positive things, like taking out costs at the plant level, regaining market share that they lost during the downturn. North Star, the team there, we added an executive to the board, former CEO of United Airlines. We added to North Star's board, to the board of another business we bought called Burtech. And having these kind of people at the table really, I guess, puts a lot more emphasis and pressure and attention on management teams.